Good afternoon, everyone, and welcome to our webinar today. We're excited to have Jason Parker from LeaseQuery, and Jason will be presenting on understanding the new lease accounting standards. And I know you're all eager to get started with the presentation. So before I pass it over to Jason, as a reminder, we are recording this webinar and it will be posted to our on-demand webinar library for you to review again or share with anyone. And if you do have any questions along the way, please go ahead and type them into our questions box and we will get them answered during our Q&A time at the end of our session. So now I'm going to pass it on over to Jason to kick off our presentation.
Awesome. Thank you very much, Angie. And we are looking forward to giving a little bit of background on our partnership with Innovia, as well as a detailed background on the new lease accounting standards. So the purpose of our presentation today is to give that baseline understanding of why the accounting standards boards have made a change to what is required for lease accounting and what those changes are. So as you can see my name at the bottom of the screen here, just to give you a little background on my particular career here, I started my career at KPMG, so I have audit experience for both public and private entities, as well as state and local governments. Today, we're going to focus on both ASC 842 as well as IFRS 16. I did graduate from the University of Georgia with both a bachelor's and master's degree in accounting. So any information that you have for me, any questions, you see my email address on the bottom right of the screen there. So that's a little bit about me. LeaseQuery itself as an organization in partnership with Innovia, we do provide a solution technology-wise for the compliance with ASC 842, IFRS 16, and GASB 87. So we effectively serve as a subledger to the general ledger system. So we love to partner with organizations like Innovia that provide general ledger services so we can assist with some of those more nuanced aspects of technical accounting, like these new lease accounting standards. So for an agenda today, background on lease accounting requirements, as I mentioned before, what we want to talk about is who actually makes accounting requirements and why did they actually make these changes. And then the second piece of this is we will talk about what those changes actually are, and we'll do it from a high level, right? We're not going to go into some of the super nuances of some of the accounting, but we do want to make sure everyone understands from a balance sheet perspective what is actually changing. And then the third piece of this is we will tie in LeaseQuery specifically in terms of the functionality in our system. What do we provide that enhances the value of your solution with Innovia? Any of the ERP systems that Innovia also provides, how can LeaseQuery as a third-party subledger assist in that regard? And before we get started, we are going to launch a handful of polling questions as we go through today. We are not offering CPE, so the polling questions will be optional for you to select. But Angie, if we want to go ahead and just launch the first polling question before we get started on the background on the accounting requirements. And so just for us to get a sense, and just for us to get a sense on who we have joining us today, we'll get a sense to see what jurisdictions that you will fall under.
So the first question that we have is, what is the nature of your organization? Select one: public, private, government, nonprofit, or other. And I will go ahead and close that in just a couple more moments. Give everyone a chance to select their option. Okay, and it looks like 100% said private.
Awesome. 100%. So this is perfectly designed then for all of our private organizations on the webinar today. Again, as you move towards your effective date of transition to the new standards, I think all of this information will feel fairly relevant. So a little bit of background on lease accounting requirements. So we're going to start by talking about why the boards actually changed the rules for lease accounting. So this will be key when you're evaluating the changes. Operating leases were previously just reflected on the income statement here. So when we start, what we're going to talk through is the difference, from a basic sense between the balance sheet and income statement, right? And this is probably obvious to most of you on the call today, but from a balance sheet perspective, you've got your assets, liabilities, and equity, and this is a financial snapshot as of a point in time. The income statement is going to showcase financial reporting over a period of time. So rather than as of date, how much money did you make during a specific period here? And so when we think about operating leases, one of these statements incorporates operating leases today, the other doesn't. So if we take a company like Delta, just as a basic example, Delta flies planes, right? That is the basis of their business. But at any point, they might have hundreds of millions of dollars in outstanding lease commitments. But under the current standard, if you were to just look at their balance sheet and income statement, you would not have any idea the amount of money that they expected to pay in the future for those leases. You would only see the amount on the income statement today for what they paid within the past year. And that is because most of these contracts are structured as operating leases, which only impact the income statement. And just as a brief reminder about the difference between the operating lease and a capital lease under today's jurisdiction, the operating lease is more representative of a true borrowing, where a manufacturer like a Boeing will actually lease out the ability for Delta to use a plane. And then at some point during that plane's useful life, Boeing has the ability to receive that asset back and potentially lease it out to another vendor. The capital lease designation is more so designed as a financed purchase, potentially due to someone leasing the asset over almost its entire useful life, or if the lessee plans to purchase the asset at the end of the lease term. Both of those represent scenarios where the lessee will most likely have control of the asset for the majority of its existence. So in those scenarios, the requirements are a little bit different today, but most leases qualify under that operating designation because that's the true nature of what a lease agreement is. So under that prior guidance, so for those of you on the call today, you would be accounting under ASC 840. International organizations would comply with IAS 17 similarly. The expense amount that is associated with operating leases, that was recorded in the income statement, right? Where we have the orange highlight, that's where you would see your operating lease expense. But on the balance sheet, there is no trace of an operating lease, right? The only thing you might find is if there's a variance between a cash payment and the amount you would recognize for the straight line accrual for expense, you might find a balance of deferred rent. But really all that deferred rent balance is showing is how much money have we yet to pay for an expense we have already recognized. So really it's just, hey, that's a little bit of extra cash we'll be paying in the future, but it's only related to the expense you've already recognized in the income statement. So again, we're taking a look at the balance sheet and we don't really know that much about our operating leases. So again, really just repeating the same thing on this slide here, but if you were looking at who you owe as of a point in time, there's not really a trace of contractual commitments for operating leases on the balance sheet as it stands today. And so what are we lacking here? If we start thinking about ways to describe the issue, one word that comes to mind that is important within financial reporting is transparency, right? So when we get into the next slide here, we'll note that there is really no transparency that results in rating agencies, investment banks, individuals who have to analyze financial statements. They have to do their own due diligence to understand what those obligations are So what happens is a lot of these firms are actually reconstructing financial profiles of companies that are heavy and material on the lessee side for operating leases. They'll include those off-balance sheet arrangements in order to get a little bit more transparency into the future state of the business and really what would then be the current evaluation of the financial statements. And so again, another problem associated with this is that they're all doing this differently, right? So if all of these organizations are reconstructing financial profiles and doing it differently, there is no consistency across the board. So in order to compare organizations against each other, there wasn't really a good way to do it, right? Without actual rules in place for how organizations can better represent their operating leases on the balance sheet. So all of this is the genesis behind why the accounting standards boards really exist in general, right? The reason that these accounting rules are come into play is to provide as much transparency as we can with as little cost to the business as we can possibly have, while also providing consistency amongst organizations. So someone can look at a financial profile, compare it to other organizations, and evaluate what is a better investment. So that's when the accounting board stepped in and say, hey, we need to figure out a more uniform way for organizations to account for leases that can increase transparency and, as we say, level the playing field to make it easier for organizations to actually receive investments for their financial profiles. And so that's where the boards came in and said, hey, we are going to author this uniform way to account for leases. And that's where our new standards come into play. So on the left-hand side, that's the standard that we'll focus on today with this group. ASC 842 would be the private company adoption standard. IFRS 16 is the international lease accounting standard. GASB 87 on the right for state and local governments. And again, these standards are enhancing transparency, right? And transparency within financial profiles will create additional market confidence. It will generate a little bit more investment-related activity. So one question that one might ask who is a little bit unfamiliar with the accounting standards is who actually writes these, right? So there are 3 relevant governing bodies related to those standards. So for our attendees today, the top one is the one you would focus on. So the Financial Accounting Standards Board, the FASB, they are responsible for authoring what's called a US GAAP. And for those unfamiliar, US GAAP stands for United States Generally Accepted Accounting Principles. So ASC 842 is a codification standard underneath the FASB's jurisdiction. And ASC 840, that is the old accounting standard that you would be accounting for up until your transition date this upcoming year. The IASB, the International Accounting Standards Board, they are responsible for authoring IFRS guidance, which is used by international organizations. And the Governmental Accounting Standards Board, they are responsible for authoring GASB. And just to clarify here, so the GASB is actually just for state and local government bodies. The FASAB, which is a separate board, is actually responsible for authoring the federal accounting standards. So there is a separate body that puts together requirements for the federal government versus state and local governments. The federal government does have a new lease accounting standard, oddly enough, that will be deployed or effective for federal departments in fiscal year 2024. So the reason we're not going to cover that today is because we are a handful of years away from the adoption for our federal departments. But just something to keep in mind is that they also have a separate standard that will be coming into play. And on the note of all of these different standards boards, just talking about who really has to comply with these. And this, again, might seem obvious, and a lot of this isn't completely binary, right? Some privately owned small businesses may not undergo a formal audit or even a review of the financials. Thus, they wouldn't necessarily need to have US GAAP-based financials, right? The idea here is that if you wanted to obtain a loan, whether it's an asset-based loan or a financial loan, those typically require audited financial statements, and audited financial statements will typically be audited based on the US GAAP jurisdiction the FASB's ASC 842. So public companies, obviously, they would comply with ASC 842. Their deadline has already passed, and we'll talk about the deadline requirements for these new standards a little bit later on here. Private and nonprofit entities also need to comply with ASC 842. So Publix being an example of a private organization in the United States, the grocery store chain that is headquartered down in Florida. Now, in addition to that, we have international companies, right? They have to comply under IFRS 16. That standard has also passed its effective date. So Spotify, headquartered in Sweden, would be an example of an organization that does comply with IFRS 16. And then state and local governments, as we mentioned, they would comply with GASB 87, and the effective date for that standard is actually upcoming within the next 2 months. So that is the next closest standard deadline. But when we move into our next few slides here, this is where we're actually going to start covering in a little bit more detail these specific deadlines for these new standards here. So for US GAAP, and we'll spend a little bit more time here since everybody on the call is working for a private company. So, as we mentioned before, the public company deadline has already passed. So organizations needed to begin compliance with all periods that began after December 15th, 2018. So for a calendar year entity, their fiscal year beginning in January 1 of 2019, that is when they began compliance with 842. And as a reminder, public companies are required to produce 10 Qs every quarter. So they had to produce their 842 accounting by the end of Q1 in that first fiscal year. So they had a pretty quick timeline to get ready. Now for private companies, there's been a few hiccups in the effective date. So initially, as everyone probably knows, private companies always have 1 additional year to adopt any new effective FASB standard. So originally, private companies had until FY 2020 to adopt this standard if they were a fiscal year, calendar year end. Now, because of the complexity that public companies experienced in adopting this standard, the FASB said, well, if public companies who are much more rigid in their processes and have a lot more individuals on staff to help with these types of arrangements, if they had trouble, private companies might also have a little bit of trouble too. So what they did was they put a 1-year delay in place. Organizations had, rather than until December 15th of 2019, they would then have until December 15th of 2020 to adopt this new lease accounting standard. So everyone was given an extra year. Now, of course, COVID-19 comes into play around March of last year, and immediately the board said, hey, this is not the type of environment that organizations should be adopting a new accounting standard in. So they decided to push it once again. So that's where we've landed now. So organizations now have the rest of this year to plan their adoption for all fiscal periods beginning after 12/15/2021. So again, that date means that if you're a calendar year entity beginning in 2022, you would then need to begin compliance with these new guidelines here. So 2022 is that big time period. And again, in terms of how you should plan for this, there's a lot of nuances that go into play. But of course, with all of these new processes, controls that you would build in, individuals who might be responsible for gathering the completeness of the lease portfolio, there's a lot of work that goes into play becoming compliant with a new standard like this. So we would always suggest well ahead of time having a plan in place to, map out exactly what needs to get done and when. So for international organizations, and this is regardless of whether the organization is publicly or privately traded, IFRS actually just offered 1 adoption date. So all organizations needed to adopt as of 1/1/2019, any fiscal period that begins on or after that date. So in that sense, one item that we always like to point out is just thinking about how difficult it might be for multinational organizations who have maybe a subsidiary that had to adopt IFRS 16 back in 2019, but maybe as a private entity based in the United States, hasn't even had to adopt ASC 842 yet. So there's a lot of complexity when it comes to multinational organizations, organizations that may eventually move internationally. Those are some things to think about if you are a business that might have an international presence there. But again, regardless of public or private, organizations that do report under IFRS, the vast majority of them would have already adopted this standard. There are a handful of unique exceptions just based off this type of organization and how it was developed that do give occasional delays in the implementation guidance for IFRS. However, in any normal capacity, organizations would have already adopted the standard. And then lastly, GASB 87. So this again is for state and local governments, and you'll notice that this effective date is for reporting periods that begin after June 15th, 2021. And what's unique in the state and local government space is that they are actually required to modify or to use the modified retrospective approach for adoption. So they actually have to restate a comparative period under these new requirements, which is not required for ASC 842. So for them, it makes it even harder to prepare for the standard because they have to go back a year. So in some essence, really it's reporting periods after last July or after last June that they would need to adopt this new standard. But again, we'll focus on the 842 standard for today's purposes with our current audience here. But with that, now that we've covered the effective dates here, and again, just as a reminder for private companies, you will begin the adoption of 842 and the effective date starts in January of 2022 if you are a calendar year end. So with that, we have another polling question that we will go ahead and launch before we enter into the specifics regarding the accounting change.
All right, Jason, I have that up there. How many leases does your organization have? And select one of the following that is listed. And we have 100% that said less than 10.
All right. So we've got small portfolios today, but that's no problem, right? Because I think even if you have one lease or even two, you do still need to think about how this might impact the financial statements as you capitalize some of this information on the balance sheet. So getting into the actual accounting changes here. So here are some highlights that we can talk through. Going from ASC 840 to ASC 842. So one of the key distinctions between the standards is the lease classification itself here. So under 840, you had capital leases and you had operating leases. We touched on this a little bit ago, just verbally, but where we're moving to. And also, as we mentioned, capital leases were always on the balance sheet. Operating leases were never on the balance sheet. Capital leases are now named finance leases. So the name changes because there's not really any change in the accounting, right? It's just a nomenclature change. And the reason it's changing is to be a little bit more representative of what the transaction actually is. As we mentioned before, a lot of capital leases are closely resembling a financed purchase. And so rather than creating a unique way of accounting, you're going to account for those leases similarly, but you're just going to refer to them as finance leases. Now, the big change for 842 is that operating leases will now be on the balance sheet. But what's unique about the 842 standard is that you still have to classify the difference between a capital finance lease and an operating lease. So those designations won't change. It's just that there is a major change in how you actually account for an operating lease because those will now rest on the balance sheet. So this is the basics just from a lease classification standpoint of 842. So to summarize, again, that finance lease designation, that is just a name change as opposed to naming them capital leases. And then the operating lease, the name stays the same, but the requirements themselves change quite a bit. And we can breeze through the IFRS as well. So the main difference with the IFRS functionality or accounting requirements rather, capital leases will also be designated as financier. Again, similarly to US GAAP, the name changes, but there's not really much change in the accounting. Those were already on the balance sheet. But what's unique about the international standard is that IFRS 16 changes the lease classification of an operating lease to a finance lease. So in summary, all in-scope leases for IFRS 16 will have one classification, and that will be the finance lease designation. So you don't actually have to worry about performing a capital versus operating lease test for the international accounting standard. So in this example here, you are just going to have finance leases and they all will be represented on the balance sheet here. And for today's purposes, we are going to keep it that simple, right? For operating leases and finance leases, you will be calculating a present value on the balance sheet to get there. For today's webinar, we're going to leave the mathematics out of it. The next section, again, we're going to go over the specific value that a system like LeaseQuery can provide as the subledger here. But we'll go ahead and just launch that third polling question before we move into that final section.
And this one is, what stage of the lease implementation process is your organization in? And select one of the following. All right, it looks like we have a variety. 33% said each of the first three.
Awesome. Awesome. So it at least looks like people are thinking about this project, right? Which I think is important, you know, as you get closer to the deadline. Even if you have a small portfolio, again, there's more processes that come into play. There's rules to learn, potentially conversations with auditors to have regarding materiality thresholds. So again, you never want to wait too long to get started on a project like this. So moving into our final section here, so LeaseQuery, what is the value that we are going to provide as that third-party subledger with any ERP system that you invest in from Innovia? So as a subledger here, the way that this basically will work is that the client or LeaseQuery as a service will enter the lease data into the system. So that lease information will live in the LeaseQuery tool. And what LeaseQuery does is we provide journal entries for the client to book into their general ledger. And those journal entries are derived from the back-end calculations that we provide based on the requirements from ASC 842. So those journal entries will move into the general ledger that you utilize with Innovia. And then from there, based on the entries that you book, you will construct your financial statements based on the information that you received from the LeaseQuery system and populate within your general ledger there. So obviously an example of our balance sheet and income statement here, but again, the basic idea is that we are going to provide all of the accruals and all of the complex calculations necessary to derive the amounts that you need to recognize on the income statement and balance. And so what we've done here is just provide an example of the 842 operating lease schedule here. So some of the changes that are going on from an accounting standpoint, wanted to give everyone a little bit of a visual here as to what's going on. So on the left-hand side, that is going to showcase every cash payment you make each period. So what are your monthly rent payments? You will see that on the far right side of our screen here. On the right-hand side, where our income statement arrow just popped up, that is going to be the expense that you are recognizing on the income statement. Now that amount is actually the same value that you would have recognized before you adopted 842. So the income statement impact is not necessarily changing, but what's changing, as you can see in the middle, is going to be the liability balance that we recognize on our balance sheet. So that top amount here, which is our opening liability balance, that is us calculating the present value obligation of those cash payments. You can see at the very top of the schedule that we will show a borrowing rate that is used to calculate present value. And you'll also see to the right of the lease liability the short-term and long-term amounts separated. So how much of that liability are you paying off within the next 12 months? That would be the short-term value. But this ultimately gives you that complex present value calculation. And then on the opposite side of the balance sheet, that is where you'll recognize your right of use asset. So ROU standing for right of use. Essentially, from a qualitative standpoint, you are recognizing, rather than the physical asset itself on your balance sheet, you are recognizing the right that you have to use that asset during the lease term. And that's where that value comes into play. And to start, the ROU asset balance can often equal the liability balance, but is adjusted if there are any existing deferred rent balances when you reach the transition. They can also be adjusted if there is a lease incentive provided by the lessor. That might decrease the value of your opening ROU asset, but nevertheless, you would have both of those on your balance sheet. And this is what a basic 842 schedule would provide you. These are all available in the LeaseQuery system for every lease that you enter into the tool. And so in addition to the schedules themselves, what else we're going to provide are reports. So you've got your lease portfolio, right? And so from the lease portfolio here, we are going to provide you all of the individual in-period disclosure requirements. And you can see a number of items here on the screen. These are representative of, again, all of the numbers that you need to represent in the footnotes to your financials within the lease portfolio within a given period of time. So what we do to simplify this in the LeaseQuery system, though, is we have created what's called the complete disclosure report. So all of your disclosures will funnel onto that complete disclosure report, which will also have as an attachment to it all of the detailed breakouts of those individual line items that you see in the middle. But ultimately, there's a key within that report there, because you can utilize that to actually populate your financial statements in your quantitative disclosures. So we're giving you everything you need from a reporting standpoint here in the section right here. So essentially, you've got your schedules, you've got your journal entries, and you've got all of these pre-built footnote disclosures. So in terms of all of the basic requirements from a compliance perspective, we're pulling that all together for you and giving it to you out of the box with your subscription with LeaseQuery serving as a third-party subledger. So again, we're solving for all of those complex calculations that you see there in the middle. So from that perspective, we can go ahead and launch the last polling question here. We've got a few wrap-up slides, and then, if anybody has any questions, we're certainly happy to answer those.
The last one is, when would you like a demo of LeaseQuery? And select one of the following, please.
Yeah, and if you see a demonstration of LeaseQuery, you will have an accounting consultant on the call. So if you have any specific questions about the accounting standard itself, that is also a good time to ask those questions to a lease accounting expert as well. So it's an opportunity not only to see the platform itself, but to speak with somebody who, spends their day-to-day buried in the lease accounting standards.
Okay, so we got 50% for the last two within the next month, and someone is already speaking to LeaseQuery.
Awesome. Well, that's exciting to see. But from that regard, just to give a little bit of a summary as to what we've talked about here. Benefits of LeaseQuery and the Innovia partnership. and understanding the nature of the lease accounting requirements and what drove the change in the financial reporting standards, and also starting complications existing upon transitioning to the new lease accounting standards, and then of course the value of utilizing LeaseQuery for compliance. So those are the main things that we obviously talked about today, and we have plenty of time for any questions that the client base has today for me. If not, we're happy to end the presentation a little bit earlier and give some people some time back. But that's really all we've got today. Again, my email address is attached at the bottom here, so any specific questions that anybody has, I am more than happy to answer, whether it's today on our broadcast or if anybody would like to send us an email afterwards, we're happy to do that as well.
All right, Jason, I don't think anybody has any questions. Someone said thank you for the great information. It was very well laid out. Thank you.
Huh?
Well, if anybody
That's good
has
to hear.
any questions after the fact, if you come up with anything, feel free to contact Jason, or you can contact your account manager here at Innovia Consulting, and we would be happy to address those questions with you. So Jason, I just want to thank you for presenting today. It was very well informative, and I hope everyone got a little bit of takeaway from that.
Awesome. Yeah, well, we appreciate everyone joining us today. And again, feel free to reach out if anybody has any questions.
All right, well, again, if you're joining us on watching on demand, thank you for taking the time out to watch this. And I just want to let you know that we have started a new round of training workshops for you and your team members to attend. And you can visit our training workshop page at innovia.com/workshops for more information and to register for the training workshop that fits your role. And we do have more webinars coming up. Tomorrow afternoon, we have Scott Rich from I-95 Dev presenting on, is your e-commerce platform keeping up in today's fast-changing world? So check out our website for more of our upcoming events, and that's innovia.com/events. And we do have a podcast going on. If you have not heard of it already, it's called the Innovia Conversation, and we just want to encourage you to listen to the selection that our hosts, Steve Waltz and Jeff Pergolski, have provided to us. You can find out about all the different podcast platforms to listen to on our podcast page, and that's innovia.com/podcast. So check out that selection and subscribe so you'll be notified when those new episodes air. All right, everyone. Well, we thank you again for joining us, and we look forward to seeing you soon on another Innovia webinar. Take care, everyone. Thank you, Jason.
No problem.